Hi all, introducing me Dian Hermalia Andesta NPM 224111067 Management Class 22A. In this video I will discuss the material of disclosure and transparency of financial statements. Disclosures in financial statements. Conceptually, disclosure is an integral part of financial reporting. Technically, disclosure is the final step in the accounting process, namely the presentation of information in the form of a full set of financial statements. The notes to the financial statements are a medium for disclosures that are required by accounting standards, and that cannot be presented in the balance sheet, income statement, or cash flow statement. Disclosure of financial statements in a broad sense means the delivery of information. Meanwhile, according to accountants, financial statement disclosure is the submission of financial information about a company in financial reports, usually annual reports. Disclosures made by companies basically aim to meet the information needs of stakeholders. Disclosure is related to information both in the financial statements and additional communications including footnotes, events after the reporting date, management's discussion and analysis, financial and operating forecasts, and supplementary financial statements which include segmental disclosures and supplementary information in excess of historical cost. Purpose of disclosure. The purpose of financial statement disclosures is to present information that is considered necessary to achieve financial reporting objectives and to serve various parties with different interests. Disclosures may be required for the purpose of 1. Protective purpose. This objective is based on the idea that not all users are sufficiently informed, so those users need to be protected by disclosing information that they are unlikely to obtain. The reason for disclosure is to protect management treatment that may not be fair and open. 2. Informative purpose. The informative purpose of financial statement disclosure is based on the idea that the intended user is clear with a certain level of sophistication. Thus, disclosure is directed at providing information that can assist the decision-making effectiveness of these users. 3. The objective of serving special needs. This objective is a combination of the public protection objective and the informative objective. What should be disclosed to the public is limited to what is deemed useful to the intended users. Disclosure concepts. There are 3 concepts of disclosure, namely 1. Adequate disclosure. The concept that is often used is adequate disclosure, which is the minimum disclosure stated by applicable regulations, where the numbers presented can be interpreted correctly by investors. 2. Fair disclosure. Fair disclosure is a disclosure that is indirectly an ethical goal, in order to provide equal treatment to all report users by providing appropriate information to potential readers. 3. Full disclosure. Full disclosure is disclosure that implies the presentation of all relevant information. Nature of disclosure used by the company. 1. Voluntary disclosure. Voluntary disclosure is the disclosure of information made voluntarily by the company without being required by applicable regulations or disclosure beyond what is required. 2. Mandatory disclosure. Mandatory disclosure is disclosure made by the company of what is required by accounting standards or regulations of regulatory agencies. B. Transparency in financial statements. Transparency is providing open and honest financial information to interested parties as a form of accountability from the company. Openness and disclosure is one of the principles of corporate governance that is currently in the public spotlight. The principle of transparency relates to the quality of information submitted by the company. Factors that encourage the emergence of transparency of financial statements, namely due to changes in the environment, precarious situations certainly make every information in the financial structure carried out truthfully. This principle of transparency requires openness in carrying out the decision-making process and openness in the complete presentation of all information owned by the company. To reduce the asymmetry of financial statement information between internal parties and external parties, transparency in the presentation of financial reporting is required. To reduce the asymmetry of financial statement information between internal and external parties, transparency in the presentation of financial reporting is required. In addition, the implementation of the transparency process in financial reporting will certainly arise when all members of the organization have a strong commitment to carry it out. Commitment shows the expression of promises that will be carried out in an organization. Commitment will certainly be realized when each party in the organization carries out its role properly. Thus the explanation of the material that I can convey, hopefully friends can understand what I explained. Thank you.